Good morning, ladies and gentlemen. A very warm welcome to you on Business Way Television. A bit of a heavy selling pressure on the Lal Street, mainly on account of geopolitical issues which global markets are facing, in particular in Europe, in particular in South America, and of course a combination of a weekly expiry. Plus, ahead of the weekend, we don't seem to be having any gumption to take long trades. The Nifty, as is there in front of you, down 200 points. Similar cut coming on the Nifty Bank as well, 59,772. And the IT index is also down about 2%. Broadly, you have intense selling pressure. Look at the profit booking that's happening in the metal space, in particular Hindustan Copper, the entire Vedant group for obvious reasons of profit booking, plus the sad event that has taken place in their personal lives, and of course on Hindalco as well as on National Aluminium. Profit booking happening there as well. But to gauge what 2026 brings, we are getting you a series of experts who have navigated the markets with great ease over the last 3 decades, and foremost among them is Mr. Satish Ramanathan. He is the Chief Investment Officer for the equity business at JM Financial Asset Management Company. Namaste Satish ji, and a very warm welcome to you, sir. What is your crystal ball telling you as far as 2026 is concerned? The first week is turning out to be a bit painful as far as the global issues are concerned, and they are reflecting negatively on the markets.
I think what we need to understand is that while the economy is reasonably okay and the earnings momentum is also picking up, the valuations were a little ahead, and markets are just looking for reasons to pull back a little bit. Also, typically, what happens in such a market environment is that you have lower volumes and lower prices with higher volatility. And actually, this is the best time to start building back the portfolio, or adding to the portfolio. But unfortunately, people get unnerved by this volatility and do not put money at this point in time, and would like to believe that a rising trend is your friend, and want to wait for such an opportunity. But the maximum money is actually made when you buy the volatile markets gradually, not in a hurry, but gradually.
Okay. So, Satish ji, one of the finest flexi cap schemes in India belongs to JM Asset Management Company. What are you doing there? Because it allows you freedom of choice in terms of market capitalization that you can add to a wealth creating portfolio for your long term unit holders. How are you now mapping the market to this portfolio in the flexi cap space?
So we have taken a slightly neutral strategy right now. What we have done is we are broadly sector neutral. We have about 55% towards large caps, about 20% towards mid and small each, and the balance is about cash and working capital.
Okay, fair point. But the prognosis for 2026, what does it hold for the short term, which is before the budget, and how are you expressing yourself in terms of expectations of third quarter earnings?
So we believe that the third quarter earnings will be reasonably good across sectors. And we also believe that this government has to push domestic economy more than it tried to push global economy. It may have to bring in some tax sops to encourage investment. It may also have to promote investment sentiment by probably reducing some taxes, maybe capital gains, etc. These are the things that the government ought to do. Whether it does it or not is completely different, but it has to push the domestic investment, savings, and growth when clearly the global environment is not too conducive for growth.
Okay. In terms of the issues that the market is facing, uh, are you by and large looking at the Nifty with a positive bias? Or given the problems globally, whether it's geopolitical, the issues that we see on ITC and Reliance in particular, these are index heavyweights. How are you looking at the index for, say, the next quarter or so?
I think the market volatility will continue, and we may probably be where we are in terms of the index and as regards the market, even though the constituents may change and their contribution or detraction may differ from time to time. But broadly speaking, that the big hypothesis is the government has to push domestic consumption to stabilize the economy.
Correct.
And the second thing is that it will pull back on investments a little bit to push the domestic consumption as it reduces taxes to, and therefore its budgetary constraints will prevent it from expanding the capex theme. So these are the broad parallels that we can take, and then the export market is going to be volatile given the current nature of the global economy, whether it be because of Europe or US or whatever it is. And therefore, we should not have too much dependence on exports as a growth engine. The growth engine has to be domestically created.
Satishji, how is your view now being curated as far as the precious metal space is concerned? As a fund manager predominantly in the equity space, all those problems that we have discussed are actually fueling the rallies in gold and silver and to some extent the industrial metal space as well. Is this a big dampener on the overall portfolio of equities?
No, clearly gold and silver have done remarkably well on a 1-year basis, maybe even on a 3-year basis. And some of it is because of the de-dollarization attempts by the central banks. Because what has happened in the global context is that the central banks are now challenged to be overly reliant on the dollar, and they need another asset class to hedge themselves should the dollar become volatile or there are the other geopolitical issues. So hence the need to diversify and keep some gold as an alternate reserve is coming through, especially for the Asian central banks and the Russian central bank. So all of this is kind of building up into a sustained demand for gold. Whether it remains at this price or lower or higher is something which is left to speculation. But broadly speaking, the sheer momentum that gold has exhibited will keep its interest going, and hedge funds and pension funds also investing in this asset class a little while longer. Therefore, the support for the asset itself comes through. As regards the returns itself, I'm no expert, but I would think that it is not going to be very negative into the future as well. So it will hold its value.
Okay, so predominantly, are you comfortable with cash, the level of cash in your AMC? Is it a conscious call, or is this something that is likely to stay as a percentage the same even if you get fresh funds on a regular basis?
With the benefit of hindsight, we could have had a little higher cash. But having said that, as a fund house philosophy, we do not keep too much cash in the portfolios, and because our portfolios are fairly liquid, and we tend to actually deploy most of the cash that we receive into the ideas that we have from our research side. But if we were to receive more cash, we would probably be little more selective in the timing of purchases of uh, further exposures.
Okay, fair point. In terms of your view on the small cap and the mid cap space, as the individual funds that you offer, and of course the flexi cap scheme as well, what is the fresh allocation to this space?
I think the basic issue about small and mid is not because they are small and mid. It is because of the volatility and the fact that the retail market is broadly absent in the secondary market, which has led to the extreme volatility in the stock prices. So, I would like to highlight the difference between the fundamental performance of the companies in the small and mid cap space and the price performance of these category of companies. The
Okay.
small and mid cap earnings momentum is quite reasonably okay. There's no problem there. Their balance sheets are reasonably fine because there's no excessive borrowings there. But the volatility has been quite high because of the fact that there's been a crowding out effect. People are leaving small and mid and moving towards large or liquidating their holdings altogether.
Correct.
And that has caused the volatility, in our view, an opportunity as well.
Okay. I think you put it very succinctly that people are getting a bit tired of this. A view that you would hold on interest rates at this point of time, is this a time to increase the bond concentration on your overall portfolio, given the issues that we face in equities and the fact that possibly there are more real estate cuts, there are more interest rate cuts in the pipeline globally as well as locally?
So, I think the interest rate cuts have not translated into actual interest rate uh, impact in the borrowings. And the reason why that is happening is because there's a tight liquidity globally as well as in the Indian markets. And what we are witnessing is the government borrowing in the long end of the curve, pushing up the long term yields a little higher than they ought to, and also suppressing the short term yields lower than what is required. So, the
Okay.
steepening of the yield curve has been led by the central government's borrowing program concentrated towards the longer end of the curve. There may be a little bit of balancing there. We could see the short end of the market moving up a little bit and the long end cooling off a little bit. But I'm no bond expert, and I would think that interest rates are not likely to come down in a hurry, because what is happening is that the central government's budget means that GST cuts and the 8 pay commission, it has many constituents to keep happy, which means that it has to either squeeze more taxes, which may be a little difficult, or borrow more. And we think it will borrow more or spend less, but definitely not tax more.
The other interesting balloon that's floating on Dalal Street, Satishji, is this possibility that the government might do something to on the tax front to get back sovereign funds, to get back foreign institutional investors who have been, voting with their feet. So, if there is a tax relief which was actually taken away 3 years ago, do you see the rupee stabilizing? Do you see these funds coming back?
See, I think what needs to be done is that there has to be a stability in tax regime. Till 3 years back, we were of the belief that we do not need foreign capital and we can manage everything on our own, which is why we said that foreigners will not get any tax breaks and they will be taxed the same way as Indians are taxed. But the fact is that we do need foreign capital, and we need more and more foreign capital as well as domestic capital to keep the economy's growth trajectory intact.
Mhm.
And what needs to be done is to course correct and make it attractive for foreign and domestic investors to invest across equities and all asset classes,
Mhm.
including infra assets, be it through REITs or InvITs or whatever
Mm.
it is,
Okay.
to keep the momentum of the economy growing. Because
Mm.
consumption is a short term fix, but we
Mm.
do need to fix our infra now and forever. Because our infra assets are way behind that of the global standards,
Mm.
and it is too early to, you know, put that off and say that we can slow it down. In fact, we need to pick up momentum in the infra space to actually keep the economy and economy's efficiency on
Mhm.
the right track.
Uh, do you feel any bullishness as far as the Indo-US trade deal is concerned? Has that been relegated uh, to the back burner or a slow burner? Do you see it happening in this financial year ending March 31st?
Uh, it's a $1 trillion question that you've asked, for which I have no answers. But having said that, it can't get too much worse from here on. And that's the only silver lining as I see it. And the basic thing is that what is happening in the US is a clear mandate to increase domestic manufacturing across the board. And I don't think that there will be a differential treatment of China and India too much unless we are able to get onto first terms with America, or we have a very favored or favorable relationship, which doesn't seem to be the case right now. So, as a result, I think exporters have been impacted, especially textiles, gems and jewelry, and to some extent handicraft and leather exports have been impacted. And whether it is 50 or 500 is immaterial, because at 50 we were not viable. So at 500 definitely doesn't make much more difference. But I think what this has exposed to for Indian exporters is very clear, that they need to diversify away from the US and create other geographies for exports. And from the government perspective, to not to depend so much on exports, but to boost the domestic manufacturing and economy through consumption and capex as well.
Uh, on that slightly cautious note, Satish ji, let's let's pause for a bit and then maybe let the first fortnight pan out in January, and then make out what's left for equities in the pre-budget rally. But in terms of stocks, in terms of sectors, any positive hopes that you would have from Finance Minister Nirmala Sitharaman?
I think it's going to be a tightrope walk, as always in a country like India, where there are so many demanding pulls and pressures for spending the tax rupee, whether it be in terms of giving it out as subsidies or improving social goods. All this is a tightrope walk for the finance minister. We only hope that there is stability in the tax regime, and it is actually expansionary for the economy rather than contraction led. So
Okay.
I think that's the only expectation from the finance ministry, that they actually allow the economy to keep expanding by maintaining modest tax rates rather than trying to increase it any further, because it could have a deleterious impact on the economy in the medium term.
Okay, on that very cautious note, Satish ji, here's wishing you a great year ahead as far as stock pick is concerned. And let's hope that we pass through this painful period with our heads firmly on our shoulders and a lot of green on our balance sheet as well as on our portfolio. Thank you for your time, sir.
Thank you so much.
That, ladies and gentlemen, was Mr. Satish Ramanathan, the head for equities at JM Financial AMC. Thank you for watching. The markets pretty much trying to defend 25,900 on the Nifty and a very deep shade of red on the IT index, 2 percentage points down. 800 is what the market has taken away from the IT index. Keep on watching. There's more happening on Business Today television.